What's happening, Hardscapers? This is episode 326 of the How to Hardscape podcast, where we talk about how you can start and grow your hardscaping business. And on today's episode, we have Cycle CPA on the show. If you don't know, they sponsor the How to Hardscape podcast, and every once in a while do a takeover episode where they just take over the podcast for an episode and go deep on a specific topic. And we've got a good one today. But Cycle CPA provides bookkeeping, accounting, CFO services specifically for our industry. So they have a lot of benchmarks and data from all the different companies that they service, which means they can speak your language when it comes to bookkeeping and accounting for your hardscape business. If you're interested in booking a call with them, learning more about their services, I highly recommend you go to cyclecpa.com or click the link in the show notes. Let them know How to Hardscape sent you for money off their services there as well. But in today's episode, they get into capacity planning, talking about labor in the field or overhead, and why this is so important to distinguish those two to have an accurate gross margin and percentage of sales in your business for those, to be able to plan for your capacity in both that field labor and that overhead labor, where setting a sales goal and knowing your percentage of labor to sales will help you set a sales goal in the future to be able to project the number of employees that you need in your business for the growth that you have planned. And they also get into some bottleneck examples when it comes to scaling, especially with that overhead labor side of things. And they also get into fixed assets as a percentage of sales as well. All of this is just great around capacity planning, and I really enjoyed listening to this, so I hope you do as well. So without further ado, let's listen to Cycle CPA.
Hey everybody, excited to dive into today's episode. We're going to take a deep dive into both capacity planning and also when it comes to adding both labor and fixed assets, so the equipment and trucks onto your into your company. And starting with labor, so it could be broken down into two separate buckets. So you have field labor or direct labor, and then you also have your overhead labor or salaries. So starting with direct labor, think of that more as everyone who's actually physically touching the work on the projects. And then when it comes to overhead salaries, think of that more as those individuals that are, even if they're on the project or on the job site, if they're not actually physically touching the work, then they're still considered overhead. Along with those that are working more on the administrative side of the company, whether it's helping with accounts receivable or maybe customer service aspects. And it's important to break those out within your financials, so that way you can see a true picture of not only what those salaries are as a percentage of revenue, but also so that also leads to an accurate gross margin as well. If it's all lumped in above that gross margin line, then it's going to give you, more of an inflated, direct costs. So that's something that you don't want. Now, when it comes to your direct labor salaries, so within 2024's data, so a collection of, a couple hundred companies within the landscape and hardscape industry, more of the install-based companies, it's looking around 17% as that average when it comes to the direct labor salaries as a percentage of total revenue. Now, when you add in subcontractors, it could be closer to around 25% of revenue. And for companies that are maybe just starting out, or maybe you're just starting out at like this specific service line, that that number could be, you could be a little bit less efficient at first, and that's important to understand as well. If you're, and the same goes with if you're adding on new team members, and they're working on the projects, you're going to want to add in a certain amount of lag time, where you're going to have to kind of expect, not only that person not being fully able to work efficiently, but then also you're looking at the time that is going to have to be allocated from your management, and maybe the potential loss in revenue and profitability be because of that as well. And then, so when it comes to capacity, you're you're going to want to be in a position where, if your crew is working on many projects and there isn't a lot of downtime, and they're already at full capacity and they're generating whatever your daily, weekly, or monthly targets are, then that's that's the most profitable that they should be. If now the other side of it, if you're seeing that your direct labor percentage is much higher and you're incurring a lot bigger of an expense in that category, it could be due to a couple different things, but ultimately, it could be due to the fact that maybe you're not at full capacity yet. Which doesn't necessarily mean that you should be cutting team members and making certain adjustments to reduce staffing. It should actually be that you should actually be getting more business, or maybe work on pricing and different things like that. And now, when it comes to measuring capacity, things that can help you to kind of think about even future scaling for labor is not only as a percentage of revenue, what it looks like more from a company wide perspective, but also, okay, how much revenue should each employee generate? And as a rule of thumb, you can almost use that. Maybe your goal is 20%. You're not working with any subcontractors, but you want 20% of revenue to go to paying your direct labor. Now you have a good understanding of, okay, if I'm going to add 500,000 in revenue next year, I'm going to need about 100,000 in direct labor salaries to hit that goal. Now, as I'm planning out, and do I have the recruiting to keep up with that? Do I have the marketing and the sales in order to generate that revenue to make sure that I'm going to be able to recoup those salaries and stay and be in a profitable direction? And salaries, both, especially when you look at it from an overhead and direct labor perspective, that's really your biggest driver of revenue. It's not only the biggest cost, but it's really, at the end of the day, if you pick one aspect of your company, that's going to be something that's really going to drive revenue and really, at the end of the day, determine if you're going to have a financially healthy company as well. And I also mentioned earlier, kind of build in that specific lag in time. Maybe it's a few months for those new team members to get trained up. And the other consideration too is, if you're a company and you're looking to grow and add on team members, just because you were able to grow from maybe 500,000 to 1 million in revenue and add on specific people to maybe help with the work on the projects, that growth could be entirely different from that growth versus going from 1 million to 2 million. Because maybe from that 500,000 to 1 million, you were able to actually do a lot of that management, right? And you were able to supervise the crews. But sometimes moving into that next realm could also mean that you're having to now train other supervisory level people. You're having to spend a little bit more time on the admin and the sales aspect, and not as much time on the projects, right? So it's and I think that's important to think about when you're scaling, because I don't want I don't want people to be overly optimistic or feel that just because we were able to do it last year, we're able to kind of grow at that same revenue rate, right? So at each area there's actually different challenges that are involved with that. So I think when it comes to scaling labor, it's trying to be as proactive as possible, right? Trying to look ahead and understand, okay, what are those potential bottlenecks that are going to prevent me from being profitable or reaching full capacity with the labor that we have. And I think some of the more common ones could be things like your training process, right? Do you have the systems and the processes to take on a new employee? Do you have the processes when it comes to making sure that the quality is going to keep up, especially as you scale, within the projects? Do you have the processes for marketing to make sure that, again, you're going to generate that top line revenue? So this is all going to have a big impact, because oftentimes if if one of those other bottlenecks holds you up and you're not able to continue to grow, but you have the staff and you've already hired them, then in essence, that's going to cause those direct labor percentages to increase over time. So it's trying to be as proactive as possible, and then also trying to match the specific skill set of the individual within your team with the jobs on the projects or even administratively as well as possible. So at the end of the day, you don't want, someone that you're paying $100,000 a year to be doing, lower end work that maybe more of an entry level person can handle, because that's kind of like a hidden way that you're actually, losing money there. Now, the other aspect about that too is, making sure that, people that you're just hiring onto the team, that they're not handling things that maybe require more advanced knowledge or experience, because there could be things that could end up going wrong, or it could take a lot longer than otherwise having another more experienced team member handle it. So and that goes along the same lines as when you're taking on fixed assets and equipment and different things within your company. On that side of things, making sure that you're finding those projects that you can utilize them best in, or else your utilization in regard to those assets are not going to be where they should be. So all of these considerations, and also thinking about, okay, we're taking on this team, and it's great because it's the summertime, but what does this look like when work starts to maybe slow down for you? If your company's seasonal and you're hitting the winter, instead of during these peak times, instead of taking on maybe some full-time employees, maybe we should think about maybe some subcontractors that can fill some of that peak season. That way, it's you're in a lot more flexible of a situation when it comes to the off season as well. And the other side of the coin, is also thinking about overhead labor, right? So within the hardscape industry, typically you want to be around the 8 to 9% of revenue. So again, think of that as anyone who's not actually physically touching the work in the field. Now, one of the biggest mistakes here is, we see companies and they get busy, right? And they feel that, because it's getting busier, that they need someone to help with maybe answering the calls or, some of the other administrative functions of the company, and maybe hiring a full-time person or, making a certain move there, which is great because ultimately you want to open yourself up to work on some of those higher level tasks, whether it's sales or other functions. But you want to make sure that you don't do it in a way that, will overly extend your overhead and, will cause you to have a higher overhead than necessary. So, and typically you want to let revenue really guide that decision making. So, $1 million company is not going to have as much overhead salaries and support there versus a $5 million company would, right? Because, you take 8% of the million, that's around 80,000. You take 8% of the 5 million, and that's going to be much more, right? So you have more to basically allocate, and get that certain support. And our recommendation is always, before you look to, add people to kind of help out with the whatever function on the overhead side there is, always first think, is there a software or a specific process that can be used to help streamline it? So when it comes to softwares, there's a lot of softwares out there that help with the field management, but is there certain softwares that can help with recruiting or customer service? The other side of it, is there a certain process or thing that you've kind of done within the company for a long time, but at the end of the day, it doesn't actually tie to any result, or it's not giving you any data that is actually necessary for the company? Or it's something that, you're still using a lot of paper and pen with certain things that can be automated, or, so that's when you want to think about a lot of these things. And it really is a true competitive advantage when you're able to maybe automate and use software for certain aspects, or use fractional staff or part-time staff or certain contractors to help leverage their certain expertise, whether it's in marketing, recruiting, accounting. So it's things that we definitely recommend. And overhead salaries, that bucket, you know, really we recommend always to kind of think twice before you add something to that, because it's not like that's going to actually generate the revenue for you directly, right? Again, it's more of a support for the operation. So you always want to think twice about that. Think about, okay, what is this going to look like? Similar to some of the direct costs, what is this going to look like when we hit some of our slower times, when we hit maybe some of those times where our cash flow is a little bit less? So making those decisions to kind of align with those time frames as well. And now, when it comes to some companies, they might have maybe a more like a higher direct labor salaries than overhead salaries, right? So, for instance, maybe this company has 25% as their salaries when it comes to the direct labor, whereas the average might be closer to 17 to 20%. However, their overhead, they're actually a lot lower than the average company. And I think it's important to mention this because sometimes companies operate in a way where, yeah, their direct labor might be a little bit higher, but that might be because they require a little less supervision than the average company, right? So it requires them to have less overhead salaries and less management, and that's how this company's business model is designed, right? So it's not a bad thing. Again, these benchmarks and these different ideas are more to use as kind of like a baseline, but you can ultimately operate your company. Especially looking at it from a bird's eye view, your goal is to make a high net profit margin, right? And there's different ways you can ultimately reach that goal as well. Now, the other side of it, when it comes to measuring capacity and just looking at how well your operation is able to scale, looking at some of the fixed assets, so some of the trucks and equipment within the company. Now, similar to when you're looking at some of the employees, really you want to be in a position where you're not purchasing some of this equipment and trucks, from the perspective of just trying to lower tax liability. You want to make sure that it's really being utilized well. Now, as an example, when we looked at the 2024 data for hardscape companies, it was closer to around 6.24 as what's called like the fixed asset turnover ratio, basically meaning, okay, how much revenue is being generated based on the fixed assets of the company. Now, because that industry median was around 6.24, and as an example on how that's kind of calculated, for example, a company might be doing $1 million in revenue. Their fixed assets might be 200,000. So you do the $1 million divided by the 200,000. So that fixed asset turnover ratio is closer to around a 5. Now, if that was the case and the company's operating at more of a 5, but the average is closer to maybe around a 6.24, that means that company could actually, in essence, take on more work without taking on any more fixed assets, to basically hit that number and generate more revenue, so that ratio increases. And the other side of it too, again, using these benchmarks as more of a baseline. Now, is there something unique within the specific service that the company provides where maybe that actually is their full capacity? Maybe they can only generate $1 million in revenue based on that 200,000 in fixed assets. And again, it's understanding that business model and the economics of that. So then you understand, okay, when I add that next $1 million, am I going to go and get debt to help to finance some of this? Or are we going to be a little bit less aggressive when it comes to debt, or are we going to really kind of be able to save up more and invest, in certain equipment, based on the cash that we kind of set aside. So, thinking about capacity, what is your goal for that specific metric, right? And this is important to also think about again, because if you're at full capacity or full capacity and your ratios instead of a 6.2, it's closer to around a 3. So you're really not generating that much revenue based on the amount of fixed assets. That could mean a couple different things, but ultimately, it would be better, right? If you're able to spend those funds instead of tied up in those assets that you're not utilizing well, to maybe put in personal investments or put into other growth initiatives and other aspects of your company. So it's important to think about. And again, I think it's more commonly seen when it comes to labor and kind of looking at capacity in terms of that. But it's also important to also look at it in terms of your fixed assets as well. Now, the other aspect is, you want to make sure that you're generating top line revenue, but also looking at your profitability at the end of the day, right? Is the economics of that $1 million in revenue and 200,000 in fixed assets, is that leading to a return? Is it leading to profitability of the company? Because whether you're scaling labor or fixed assets or just your company in general, you want to make sure that ultimately you're not scaling a bad business model. And that's incredibly important, and that applies, I think the most common thing that we see is like if a company is starting a new service line, or if it's just one person operating in general, you want to make sure, again, that you're profitable before you start to expand that. So maybe a solo operator, as an example, they should in essence be almost operating at a 40-50% net profit margin because there's not even direct labor to incorporate yet, right? So it's also important to make sure that if these numbers are not where you want it to be, so maybe you're looking at your overhead salaries, right? And your overhead salaries are at 15%, and we know that that's high. Is that what is your plan, right? Is your plan to increase top line revenue to basically then be able to recoup that? And if as an example, if that's the case, then you want to build in points throughout the year, whether it's monthly or quarterly, where you can have check-ins, right? And ultimately, those check-ins are designed to measure the progress towards that goal. Now, if 6 months go by or whatever time frame that you determine, and you don't see any progress towards that goal, you don't see that you're actually able to generate more revenue, more sales, and you know that your profitability is maybe 5-6% less than you'd like, you have a pretty good understanding that, it might be the overhead salaries, right? That's one of the main contributors to you not generating that high net profit. Now, I think it's important to think about, okay, what decision do you basically take from there, right? So you're not able to generate the top line sales to recoup that. Now, do we repurpose some of those people to help in other functions, right? To basically open you up to do more sales and more marketing to try to drive in more revenue? Do we cut some of those positions, right? So, but I think it's important to basically not have the certain business model or the economics go on for too long, right? You want to be able to act quickly based on what you're seeing. And like I said, if the numbers are not where you want them to be, you want to come up with that plan. And oftentimes it's, okay, are we trying to build in more sales, right? Or it could be even more of a pricing issue, right? Which again, if your company's at full capacity and you're confident that your team is working efficiently, but your direct labor as a percent of revenue is incredibly high, that is a pretty good indicator that you should probably increase pricing, right? Now, if you're not as well in tuned, or you don't have as well of as good of a training process set up, or that certain things are not being done efficiently, it's always good to first work on those, because then what's going to happen is you're going to start to price your work and try to get jobs out there in the market and you're going to find that you're actually outpricing it because of more of internal things happening within your company. And again, that's why it's almost seen as a competitive advantage, right? When you look into your numbers like this, right, and you're able to really dial down and operate from the position where you're really managing your labor and your fixed assets well, that puts you in a position where you can make the same profit margin, and even a higher profit margin than other companies in your market, while also winning bids, because in essence you're not having to recoup a bloated overhead, or you're not having to recoup certain inefficiencies, right, that maybe you once had. So it's always great to try to handle things as much as possible that are within your control first, right? So again, overhead salaries, you got software, different processes, direct labor, is it training, or is it finding the right people to perform the right work based on what their skill set is? And then the fixed assets, again, trying to find those projects that they can really be utilized well in. And sometimes that also might mean that you might want to limit the amount of service lines that you offer as a company, or limit the types of jobs, because yeah, you might be able to utilize that skid steer very well on a specific kind of job, but you only do that kind of job maybe once every couple of months. So that skid steer is not being utilized to its fullest capability. So is it actually better to maybe not offer that specific type of job, double down on what you're currently doing, sell that skid steer, put that into marketing, and then now you're more specialized within that specific kind of job, right? So, and there's a couple different ways, and that's kind of the beauty of all this is, there isn't one way to, kind of run a profitable company. Even out of the hundreds of clients that we work with throughout the country, each one takes a very different approach, to the point where some don't even have internal field labor, right? They work with all subcontractors. But again, it's kind of trying to figure out, okay, what do you do best? What can we create kind of that business model, whether it's $500,000 or $1 million or $2 million in sales, and are we confident enough that we can grow that, right? Do we have that confidence that we can grow by 25%, 50%, and the business model is not going to crumple, right? Or that we're not going to reach that bottleneck immediately within the given aspects of the company. So I hope this helped to give you guys clarity in regard to, both maybe just some thoughts around the capacity planning, and then also adding on overhead labor, and then also some of the field labor and the fixed assets. If you guys ever have any questions, don't hesitate to reach out. You can visit our website at cyclecpa.com. All right. Talk to you soon.
Thank you for listening to today's podcast episode. Once again, check out Cycle CPA at cyclecpa.com. Learn more about their services, book a call with them, get that conversation started sooner rather than later, and let them know how to hardscape sent you for money off their services there. They also post educational content on their Instagram page, cycle_CPA. So that's a great Instagram account to follow there. And they host the Green Industry Profits podcast, if you're looking for another podcast to dive into there. And thank you for listening to this episode, and thank you to Cycle CPA for continuing to support the How to Hardscape podcast. They really help us keep this thing going for the industry. And we look forward to meeting with you next week on the How to Hardscape podcast.